All right, good morning, guys. Welcome, welcome. Welcome to day two. Bright and early. What's up, everyone? Okay, just getting this up and going here. Again, we'll wait about 3 minutes before we get cracking here. Just get everything up and going. Good morning from Alaska. What's up? It's awesome. What's up? Coffee. Yeah, that's fair. That's fair. Morning, guys. What's up? What's up? What's up? Again, we'll wait 3 minutes here and then we will be off to the races. 6:18. Had a very fun night of sports last night. Utah Mammoth just looking as good as ever, if we're being honest. Pretty exciting. Let's see here. Let's go ahead and share this. Bada bing. Boom. There we go. Awesome. Yeah, the Mammoth are looking real nice. Very, very exciting stuff. Okay. Also, just working on a quick little Discord issue. A few people saying they have a hard time. We were making some updates and some issues happen. That's okay. Let's go. Bada bing. Settings. We will address that later. All right, guys, it is 6:18. It is about that time. I know the Mammoth Zamoth. How funny was that? Absolutely hilarious. Okay, guys. Well, what do you think? Should we start learning? Start going over some stuff? Shoot, might as well. We might as well. Pulling up this. Okay, perfect. All right, guys. Well, welcome to day two. Today it is about the basics and it is about understanding really what it is that we trade and what it is that we are trying to do and accomplish on a day-to-day basis. I think there's so much about the stock market that is fun and that is exciting. And today's, no different. It's it is exciting, but today is one of those days I'd say is probably the least exciting of the actual learning, just because we kind of have to go over some basics. So bear with me and understand that it gets today is kind of the ramping. It will always be more and more exciting every day following today. So today is very important because we got to lay the foundation. But again, as far as excitement goes, it will get more and more exciting. So with that being said, let's go ahead and discuss and talk about what we need to go over today. And a few of those are establishing what the stock market is, establishing what stock options are, kind of how they work in relation to each other, and maybe diving into a little bit of technical analysis. So, I guess to start, when we're talking about stocks, okay, and the stock market, what is the stock market? The stock market, which we've talked about quite a bit in our 3-day challenges, 5-day challenges. So if you're here from one of these, we're going to just be expounding a little bit on this information. The stock market is a place where you can buy chunks of companies that you believe in and that you like. Okay. I'm a firm believer that, you know, when the stock market was created, it's just in line with what America is, right? America is a funny place. It's a lot of opportunity, lot of ways to get rich, and a lot of ways to, I don't know, have opportunities to kind of create for yourself. But it's also kind of double-edged. I feel like a lot of things in America, it's yeah, but there's a lot of risk involved, and there's a lot of opportunities for you to lose money and to not, do well. And the stock market truly is no different. Think about the biggest companies that you know in the world, right? Especially here in the United States, we're talking companies like Tesla, Apple, Google, Meta, right? Used to be Facebook, Amazon, right? These are companies that are so big and have so much, I don't know, impact on people's day-to-day lives. The stock market's a way where you can invest in these companies and actually own small portions of the company. So think about owning a chunk of a company or a piece of stock, just like I don't know, I compare it to a sports team, right? Think about here in Utah, the Utah Jazz. Let's say you love the Utah Jazz or you love the Utah Mammoth, and you're like, man, I love them so much. I wish I could own a part of the team, right? So imagine Ryan Smith, he's the owner, right? He comes out and says, hey, you can buy for as little as you want, for $1, for 50 cents, whatever. You can buy an ownership stake in the Utah Mammoth or the Utah Jazz relative to what the value of that team is. So let's say the team's worth $1 billion. Well, if you bought $1 of stock or ownership in either team at $1 billion, well then you would have $1 worth of ownership in $1 billion company, right? And so the percent of your ownership would be extremely small. But that is what owning a stock is, okay? So stocks are the traditional form of investing. This is what the stock market kind of was founded on, and where most people who are involved in the stock market are investing, right? So a few things when it comes to a stock. When you own a stock, you want the company to perform better. And the price of the company, just like a sports team, right? Again, I love analogies because it helps kind of create real life scenarios and makes it easier to understand. So if you're looking at this sports team, the Utah Mammoth, well, as they continue to win more and more games, what happens? More people show up to the games, more people are buying jerseys, more people are spending money on food and alcohol at the games, more people are tuning in and watching the games, and all of that produces what? For the team? Revenue, money, and the more desirable the team becomes, the more people want to get involved. So, just like a sports team that gains more value as they continue to perform better, companies are no different. So, one of the biggest success companies that we have seen really in the last however long, we can pull up the 3-year chart here. Look at NVIDIA. Okay. NVIDIA is a company that, you know, however long ago, 3 years, whatever, it was at 26 bucks. Here we are up in the 212 range at the high. I mean, that's a gigantic return, right? So there are companies that stand out, right? And the better they perform, the more the stock price drives up and the more interest people have in it. So I think that that's a really important piece to understand about the stock market, okay, is that stocks price, the value of the company, the value of the sports team, they typically move up in price the better the team does. So again, let's say the Mammoth, for some miracle, were to win the Stanley Cup this year. Well, guess what? If they were a $1 billion company before that, they would be a lot more than a $1 billion company after that. So your $1, let's say it's now a $10 billion company, right? Or $10 billion team. Well, now your $1 in the Mammoth is now worth $10, right? Because it 10x the value. What's the same with stocks? Okay, so what makes a stock desirable, or what makes a stock, I don't know, appealing for people to buy? Well, a few things, right? When the company performs well, okay, when the company is, obviously bringing in lots of money. Also, when companies have long-term vision, right? So NVIDIA, one of the big elements that makes them so special, right, is they are creating chips and processors, right, for artificial intelligence, which is absolutely bonkers right now, and for a lot of different ways to, utilize these chips. They also have their own AI front, right? There's just a lot going on with them. Tesla, right? Another example. Why is Tesla such a high valued company as a car company? Well, it's all part of Elon Musk's master plan, right? Electric cars, then SpaceX. He's trying to make the human species a multi-planetary species, right? Wants people to be living on the moon, living on Mars. So it's exciting, right? And I think that's a cool concept of the stock market, right? And it was always something that appealed to me because I was like, man, that's cool. Like, you like Nike shoes? Well, you can actually invest in Nike, the company. You like watching Disney shows or Disney movies? Well, you can invest in Disney, right? You like how Google's search engine performs? Well, you can invest in the company of Google, okay? So the way you make money when you purchase a share or a stock, and again, that's how it works. You can literally enter or you can buy stock in any company for as little as you want, right? You can buy a share with probably a cent, right? 10 cents. It doesn't matter. You get a relative percent ownership based on the amount of money you put in and the amount of money that the company is worth at that time. So when you buy a stock, okay, this is called stock equity shares. This is when you actually own a piece of the company. You make money when the company's stock increases in price, right? So again, going back to the mammoth, let's say, or let's use the Utah Jazz as an example. Let's say you bought stock in the Jazz, or you bought a piece of the company back when, for those here in Utah, we had Donovan Mitchell, we had Rudy Gobert, we had this team that was best record in the NBA, right? All this stuff going on. Well, that was a valuable team because they were performing well. You can't miss TV, all the things. Well, now the Utah Jazz are one of the worst teams in the league. So let's say they were worth $5 billion dollars when you bought $10 worth of the Utah Jazz ownership, back when we had those people. Well, now let's say it's only worth $1 billion. Well, that means if your $1 investment, right, at $5 billion, well, now at if it's valued at $1 billion, well, your $1 is not worth $1 anymore. It's worth less, right? So does that concept make sense? It should. It's pretty straightforward and simple. And I think that it's such a good base to understand. We don't really talk about it much more than just what we're talking about right now. But I want to make sure you guys understand the concept of how the stock market works, right? And how you can actually make money. And when you buy a share or you buy stock in a company, that's what it means. It means, hey, the company does well, you're good. Your value of your ownership is going to increase in value as the team or as the company increases in value. If the stock starts decreasing in value, well, your ownership is going to also decrease in value. And then there's times in the stock market where things happen, even if the company doesn't do anything, right? So if you guys remember GameStop, right, that whole saga that happened, and if you didn't know, GameStop, kind of this dying company that you know sells video games. It's a video game store. It caused one of the craziest turnarounds in the stock market, right? However many years ago, because what happened is all these large hedge funds and large, trading groups, people, let's call them, had bets against the GameStop stock, saying, "Hey, there's no intrinsic value here. The company's going to go out of business, right? So we're going to bet that the company does poorly." Because in the stock market, there's always two sides, right? There's people who are betting for a stock and there's people who are betting against the stock. So when the people who are betting for the stock, right, when the price starts going up, they're making money, and the people who are betting against the stock are losing money, right? It's just like any type of wager that you could have, right? If you bet with your friend on a sports game, well, whoever wins that game, one of you you or your friend will be a winner, and one of you, you or your friend will be a loser, depending on which side you bet. So that's the same concept of the stock market, right? Someone is always losing and someone is always winning. So every time you hit buy, right, someone else is exiting a position and you're entering, and every time you hit sell, someone is buying when you are selling, right? And it could be for a win, getting into a position, could be getting out for a loss type of thing. So that's what the stock market is. Now, stock options, okay, this is what I trade. Okay, so stock options, and I think this has been my favorite way of explaining it over the last little while. Stock options, all right, are a way for you to not own a piece of the Utah Jazz or the Mammoth, not own, right, a piece of a company like Nvidia or Tesla or Google or whatever, but it's essentially giving you the opportunity to bet on the stock or on the company you are looking to trade, and you can bet whether it's going to go up or whether it's going to go down. So if you own stock in a team, let's say the Utah Mammoth, right? If you own a piece of ownership or you own a piece of Apple, the company, that's a long-term play more than likely, right? Because you are buying ownership. And when you buy ownership in something, it's because you believe long-term, right? You believe that there is more to come, that over a period of time, you're going to see a lot of growth. Where options, right? When you're thinking about in relation to owning, right, a small chunk of a team, let's say you wanted to bet $1 with your friend on one Utah Mammoth game, right? So you're not buying ownership in the Mammoth, you're not buying ownership in Apple saying, hey, I'm in it for the long haul, let's see what this does. It's more so, hey, I want to bet $1 tonight that the Utah Mammoth are going to win. I'm going to bet $1 today that Apple is going to drop in price. And so that's what trading options is. It's a way that obviously, right? If what's easier to have happen, okay? Apple, let's say the company, is it easier for Apple if you bought in with $1 and the company was worth, again, let's just say $1 billion, it's worth a lot more than $1 billion. Do you think it's easier for Apple to go from $1 billion company to a $2 billion company, or to bet that day whether Apple's price is going to go up or whether Apple's price is going to go down? Which is easier short term, right? Like which is going to happen sooner, right? Well, obviously, betting on the individual day, or same with the Mammoth. If you're like, hey, I'm buying ownership in the Mammoth at $1 billion team, well, what do you think is going to be easier to make your dollar back, right? Or faster, or you know, with less factors going into it? Well, if the Mammoth perform well, maybe over a few years, whatever, you'll see the overall value of the company increase. Where I can bet $1 with my friend tonight on the Mammoth game, and if I win, I'm going to make $1, right? But just like anything, there are flip sides. So if you own part of, let's say, the Mammoth, and they start having some struggles, well, the team might not lose a whole lot of value, right? You may not be making money, but you may not be losing a whole lot of money. And then maybe you are losing some money, but it's okay because you own part of the team. So it's like, I'm in it for the long haul, having a bad year. Even the Utah Jazz right now, right? It's like, yeah, they're having a bad year, but they'll come around and, you're hoping that your ownership will go up. Same with a house, right? Yeah, maybe you bought your house in the peak of everything, and now you're actually upside down, right? Maybe your house is worth less than what you bought it for right now, or about the same, right? Where other times you buy a house and 3 years later it's doubled in price, right? Just depending on how the market is. So again, going back to if you are trading options or if you're betting on the game, that's not the case. You don't have to worry. It's like, yeah, I'm either going to make $1 tonight or I'm going to lose $1 tonight, right? I don't have to wait for what the team does this, that. I'm not betting on the Mammoth long term. I'm not betting on Apple or Nvidia long term. I'm just today believing that price is going to go up on Apple or price is going to go down on Apple. Or I'm betting that we are going to win the game tonight, or I'm betting that we're going to lose the game tonight. So does that make sense, the difference between options and stock as we've explained it thus far? Does that concept make sense? And I think, again, you guys probably know these pieces of information, but when you truly understand it like we're talking about, it makes a lot more sense to just grasp the idea of, okay, so that makes sense of why options move the way they do. That's why, the difference between investing in the stock market, buying shares or buying equity, right? Ownership in a stock or in a company versus trading options, which is merely we're just checking on the day, right? So there's a whole lot of different ways to trade, right? So then options, okay, you can't just hold on to them forever, right? It's not like ownership in a team where it's like, yeah, I can hold on to that ownership of Apple or that ownership of the Utah Mammoth for as long as I want to, right? Just hoping that it continues to go up, 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 and then I get to decide essentially when I want to get rid of it. Where if I'm betting on a Mammoth game tonight, well, I need to, it's gonna happen. I'm either gonna win money tonight or I'm gonna lose money tonight, right? And there's like a time limit, right? Because the game, we're betting on the game. We're not betting on the overall performance over years. So it's the same with stocks, right? When you're trading options, they have expiration dates, meaning we are specifying, hey, we want this stock to move up or down in this period of time. Okay. And so a few key critical terms to option contracts that I want to go over with you guys that again, hopefully will make sense. And especially since we've laid that foundation of what the stock market is and what stock options are, should provide some a pretty good idea of how things work and how things operate with options. Okay. So the way that option contracts work is every company has a stock price. Okay. So this is if you just wanted to buy ownership in NVIDIA where you own one whole share. Well, to them, right now, with what the company's valued at, to buy one share of NVIDIA, you can see right here, it would cost you $185. Okay, $185 to buy one share. Now, obviously, if you bought $10 worth of NVIDIA, you would have a portion of one share, right? Which would be an overall percentage of the massive company that it is. But they break it up into shares, and that's how the stock market works. So they have, deemed that the value of their share to invest with them, $184.45 right now. And you can see it's updating in real time as people buy and sell the company. The way the option contracts work is they are saying, okay, you don't want to own a piece of NVIDIA, no problem, but you do want to bet on it today, right? You want to bet, you want to decide which way the stock is going to go. And obviously, there's a gigantic difference between us buying option contracts, believing which way price is going to go versus betting on the Utah Mammoth because we actually can identify which way the stock price is going to go, which helps us know what to bet on, right? Whether we are betting that price is going to go up or price is going to go down. Okay, so an option contract, that's what it's called, an option contract. That's like your bet slip, right? So think about you go, right, back in the day and you're like, hey, I want to bet on the Mammoth. Cool. Well, they'll provide you with a bet slip, right, at a bookie, right? And they'll be like, all right, here you go. As you can see, you bet $10 that the Utah Mammoth were going to win. They had odds, right? Meaning they were not supposed to be the winners of this game. So maybe it's at plus 120, meaning, yeah, if you know, enter with $10 on this bet, you'd make $12 in return, right? Because of the odds, right? So they can make it up that way. But you have your bet slip, right? That shows, cool, you are betting that they're going to win. Well, the option contract's essentially the same thing, right? So I'm just going to show you here. And again, you don't need to worry about having this set up or really grasping what's going on here yet. But you can see here, these are the contracts. Okay, so these are the bet slips, you could say, if you believe that NVIDIA is going to go up in price. And these are the bet slips or the contracts if you believe NVIDIA is going to go down in price. So the type of contracts that you can buy, there's two different types, okay? There's what's called a call. So you can see right here, CALL, and what's called a put, PUT. So these are terms you're going to become very familiar with. And what a call contract is when you believe the stock price of the option contract is going to increase, right? So if you buy a call contract, that means you believe, hey, I want a contract that does well or increases in value when the team does well. So this would be like betting on the Mammoth to win the game, right? If you bought a call contract, okay? And then the put contracts, this is if you believe the Mammoth were going to lose the game, okay? So again, if Nvidia's stock starts decreasing in value, then this bet slip or this contract will increase in value, right? Because again, you are betting that they are going to lose. You are betting that the price is going to drop. And that is something that is not really doable to the extent of which this is when you own ownership in a team. Because if you own ownership in something, well, you always want it to do well, right? You never want it to do poorly. Well, when you own a stock in a company, you want it to do well. And so that's where the traditional, oh, the stock market's down, my portfolio's down, things are going bad. Whereas an options trader, it's like, no, we don't care if price goes down. We don't care if price goes up. We can make money whether it goes up or down. We just need to accurately identify if price is going to go up or if price is going to go down. And then we just buy the correct contract or we bet the right way. It's like the Mammoth, right? Like I could bet 50% of the time that the Mammoth were going to win and 50% of the time that the Mammoth were going to lose. And as long as I chose on the right day, I could win 100% of my bets, right? Does that make sense? I think that's a really crazy concept about options trading is that you actually can make money whether the stock or the team does well or does poorly. But again, it makes sense when you think of it in the betting terms of what we're talking about. Um, Pretty wild. And the reason I love that is it makes this skill set unbiased. Okay. Unbiased meaning we don't care if the stock market does well, right? Even just look at today, right? What's going on in the world? It's insane. And trust me, there's a lot of horrific things with war and a lot that I don't agree with and a lot that I do agree with all this. I'm not talking about that. I'm talking pure logic. Okay, so take all the emotion and feelings of what's going on, just remove that, and let's just talk logically. As an options day trader, whether we go to war or we don't, or Trump wipes out Iran or we reach the ceasefire that we did. Again, I'm not talking about what's morally right. I'm just strictly speaking logically. I don't care, right? Like it does not affect my livelihood, right? Because if war starts, guess what? The stock market's going to tank, and I'm going to be betting against, right, the stocks that I trade, right? If we can identify, yep, it's going to keep going down. We reach a ceasefire, right? Last night, and you can see the stock market reacted very positively, right? Nvidia got down to 173 at one point. Now it's up at 185, right? SPY, one of the overall market indicators, got all the way down to what was it yesterday here? This little zoom icon's in my way. 651, and now it's up at, got up to 678. Massive moves, right? But point being is you will have a skill when you learn how to trade options, when you learn how to accurately identify whether a stock price is going to go up or going to go down, you'll be able to make money regardless of if everything is just tanking or if everything is going up. It truly doesn't matter. We just want to be able to identify which way it's going to go. And again, when you think about it in the terms of betting on sports, right? You have a few different options. So you can see here today, this is Wednesday, April 8th. So you can see these contracts or these bet slips are for April 8th expiration. That means that, hey, if you buy calls, you literally will make money if the stock is increasing in price, but you have to sell this contract today. Like after today, that's it, right? So this would be like betting on an individual game, right? Of the Utah Mammoth, right? Where it's like, yep, I believe they're going to win or I believe they're going to lose, right? You can see April 9th. So maybe they have a game tonight and a game tomorrow. So if you buy one of these contracts, right? Well, then you're kind of betting that over the next 2 days, right? The Mammoth are going to be doing well in their games they're playing, or over the next days they're going to, and you can go all the way out. So you can see there's different ways, what's called expiration dates, okay, with these option contracts. What's interesting is regardless of which contracts we purchase, we are buying and selling within the same day. Okay. And the reason for that is because as day traders, again, if I have $1 invested in the Utah Mammoth looking for long-term growth, great. It might take me 2 years for that dollar to double. Well, with the game itself, right? If I bet $1 that the Utah Mammoth are going to win, I can double my money that night if the Utah Mammoth win. Does that make sense? So you can invest $1 in the team. It might take 2 years for that money to double, right? Or you can invest $1 in a game and you can double your money. But just like in sports, let's say you bet $1 and the company does poorly. Well, yeah, you might be down 30% if the team does poorly over the course of a year. But if the team loses and you bet $1, well, you could lose your entire dollar, right? So that's important to understand. Okay, so we have the different types of options, which is the calls, meaning we believe the stock price is going to move up. We're betting that the stock is going to go up. And then we have the puts, which means we are betting the price is going to go down, right? Obviously, we want whichever contract we buy or our bets, we want it to increase in value. And you now can see why or how those increase in value. Now, as far as expiration dates go, what expiration dates do we choose? Well, most stocks, okay, until just really like this year, pretty interesting, have what's called weekly expiration dates. Okay, so that means the contracts or the bet slips you buy, you have a week's worth of time for them to move in the direction that you bought, right? So if you bought calls, you can see you can hold on to these until April 10th. If you bought calls in here, you could hold on to these calls until April 17th. But as day traders, again, we never hold until the expiration date. We are always in and out. So we buy and sell within the same day. So now stay with me here. And I think this is where it's all going to make sense. And again, I've never taught it this way, but I was really thinking about it. And I was just like, I think this is going to make the most sense just logically to people. Is let's say, okay, so we have the April 10th expiration. Now let's go back to NVIDIA. Okay. So the April 8th. So this is today, right? Well, the stock market opens at 7:30 and then it closes at 2 p.m. Mountain Standard Time, right? Opens at 7:30, closes at 2 p.m. Mountain Standard Time. Yep, you buy to open, sell to close regardless. Exactly. So if it's calls or puts, just like if you were going to a bet slip, Ryan, right? If you're like, hey, I am betting that the Mammoth are going to lose, well, you would need to buy that bet slip that they're going to lose. So if you are betting against NVIDIA, you need to buy the put contract. Does that make sense? So it's just you're just buying and selling to get in and out of your bet slip or of the contracts that you're looking to buy. But now, okay, let's say, hey, we buy this call contract. So we believe NVIDIA is going to go up. Let's say we buy it at 7:45. Okay, 7:45. So 15 minutes into the market being open. And 10 minutes later, okay, let's say the Utah Mammoth score a goal. And it's almost like the odds or odds work, you can see that, hey, when you bet, anyone who sports bets knows they give you what's called a cash out option. Okay. And the cash out option meaning, hey, they just scored a goal. It's 1-0 early in the game. We are now going to say that your dollar is worth $1.20. So if you want to, you can sell your bet that, the Mammoth were going to win, and you can make 20 cents on that dollar that you invested. So it's kind of a way to be like, oh, okay, I don't have to hold on to this bet slip or this ticket till the end of the game, just this all or nothing. When they score a goal and it's 1-0 Mammoth, they may say, yeah, you can sell right now your ticket for $1.20 because we're mitigating our risk as, the people who are, the bookie, the sports bet were like, hey, statistically, the Mammoth have the advantage to win. So we don't want to pay you $1 if the Mammoth win. We'd rather just pay you 20 cents. So they're up right now, we'll give you 20 cents. Or vice versa, right? If they're like, hey, the Mammoth gave up a goal within the first 15 minutes of the game, right? And now it's like, hey, it's okay. If you don't like how the Mammoth are playing right now, you can sell for 80 cents, meaning you'll only lose 20 cents, right? On your dollar that you invested, you'll only lose 20 cents, right? Because now the Mammoth are less likely to win because they're down 1-0. And so you don't have to sit and wait until, you just lose your dollar or you win your dollar. You can sell for a fractional loss for a small loss. Does that concept make sense? Stock market is no different, okay? Is when you buy calls, okay? let's say we bought calls right as the stock market opened yesterday. Okay. Let's say right here, we bought calls and price started to push up. Well, as price is pushing up, the value of your call contract, right? Your bet that the stocks will go up, it's going to be increasing in value. And you'll actually be able to see when it's happening live, hey, we see that this is increasing in value by X percent, right? Those contracts. So this move right here, and this is what's so crazy, guys, is because of the way that the option contracts move. The move from if you bought calls right here and sold right here, okay, that is from 175 to 176, okay? If this was right yesterday and you bought a April 7th contract, meaning it was expiring that same day, well, your price, whatever it cost you to get into this position or the call contract that you bought, let's say you bought it for $100 right here, there's a chance, right? And it'd be interesting to go back and actually look. And you know what? I'm going to because we have time. Let's go ahead and actually look what this is. So 175 yesterday, the April, we'll call it the April 8th contracts, 175. So that would mean we would be buying the 176 calls. Okay, let's go ahead and watch this. Okay, so we're going to go this, the 170. I guess that'd be the one. Yeah, it'd be the 175 calls. Okay. So give me just 1 second here, guys. We're going to do this. I'm going to show you exactly how much it moved. Okay. So we're going to go back yesterday. So I believe this was the 7th. Okay. So had you bought right here, okay, at $1.99 and sold at the top of that move at 306. Let's do some math right here just to give you an idea. So that move that we just saw yesterday, okay, from here to here is a 53% return on your money invested. Okay. So it was moving up enough in just these first two candles. Okay. This is the first 10 minutes of the stock market being open. So if you bought calls right here and sold right here, which would be, again, tough to do to pick the exact bottom, the exact top, but in 10 minutes, 53% return on the money you invested. Crazy, right? And again, that's because just like in the game, this would be like the Mammoth scoring 2 goals in the first period of the hockey game. Or this would be like the Utah Jazz going up 20-0 to start the game. And so it's just like, oh, geez, like they're looking really good. So yeah, you're gonna have to, we're gonna have to really give you a tempting offer because it's looking like, yeah, they're gonna do well or they're gonna win. Right. And so your $1 that you invested, they may be like, hey, we're going to give you $1.50, right? So we'll actually, allow you to win, 50 cents here. You're only, we're only 10 minutes in the game. It's not looking good. So you can sell your call or your bet slip that the Mammoth are going to win for a 50-cent return on your dollar for a 53% return. Because we don't want to lose the whole dollar. We're hedging. It's their way to make it so they don't have to lose everything if they don't want it. But then what happens, right? You can see, price starts pushing against them, and you could be up where it's like, yeah, if you sold right here, you could have made 50 cents on that dollar. And if you wait 20 minutes later, this would be like the Mammoth being up 2-0, and then at the end of the first, the Mammoth now are down 3-2, right? So you could go from being up 50 cents and have an offer where it's like, hey, if you sell right now, you're going to make 50 cents with that dollar you invested to, hey, now if you want to sell right here, we're only going to give you 80 cents or sorry, we're going to offer this to where you lose 20 cents if you sell right here, right? So that's a 70-cent swing on your potential earnings, right? Based on the movement of that. And so that's the way that these option contracts work, right? Where you buy and it moves, especially if the expiration date is near, right? Meaning, yeah, we're kind of just betting on one game. We're betting on one day. And then even on that one day, we're making it even smaller. It's like, we're kind of just betting on that first little bit of the game, right? It's kind of like, yeah, if we're watching the Utah Jazz, we're really just trying to make money in the first quarter, right? If it's a hockey game, we're just trying to make money in the first period. We're never going to hold to the end of the game, right? We kind of want to make money when we start seeing moves like this, right? And so that's what's cool is as day traders, our goal is trying to find areas like this where we can buy puts, right? When the put contracts have the best value, and we're looking to buy calls when call contracts have the best value. So what that means is, yeah, when everyone is buying calls, betting that the Mammoth are gonna, do well, right? What do you think those put contracts are going to be? It's like, oh yeah, you want to buy a put contract? You want to be betting against the Mammoth? They're up 2-0. We'll give you great odds on that, right? So what may have cost you $1 right here, it may only cost you 30 cents right here, right? It's like, yeah, you can bet 30 cents that the Mammoth are going to win. That's great. Well, now if you do that, then you get this turnaround. Well, now that 30 cents that you just bet, it might be worth $1 right here, right, on this move, because they're like, oh my gosh, like, yeah, like this is crazy, like crazy turnaround, right? It was huge, heavily favored that they were going to be winning, and now they're actually losing. So now everyone wants to buy, put contracts. Now everyone's thinking, oh man, now they're going to lose. And so the value of your bet or the value of your contract that you purchase is going to increase in value as well. Okay. So that's the idea and concept behind options trading. Okay. Is that we are looking for small moves, right? Just like sports, we're looking for the team to go on a little bit of a run to show maybe that they're doing well or maybe they're doing poor. We don't look at the whole overall big picture. We don't care. We're just looking at the small immediate moves. And the last thing I'll say here before we move on is, let's say you're watching a team and hey, the Utah Mammoth start out hot, or the Utah Jazz start out really, really hot. Well, that could be to your advantage, where it's like you don't care if they win the game. You just want them to do good from, minute 1 to 5 of the game. And as long as, based on stats or whatever else, you can see that they are doing well during that time, as we just showed you with option contracts, you can make a crazy amount of money in a very, very short amount of time. Last thing with this before we move on, and this is really important. Options have limited downside. Okay. So if I bet $1, again, that the Mammoth are going to win, if they lose, the worst that can happen is I will lose that dollar, right? It's the same with options contracts. So if I bought an option contract for calls right here for $2, let's say, and the rest of the day, just tank, 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 the most money I can ever lose on that option contract that I bought is $2. That's the most I can lose. So if you have $10,000 in your trading account and you put $200 into a contract for NVIDIA, let's say, the max you can lose is $200. You can't lose more than what you bet for, right? But just like in sports, if you have odds where it's like, yeah, it's 10-1 odds that the Mammoth are going to win tonight. Well, if you bet $1, you could win, based on those odds, $10, right? But the max you'd only lose. So it's like, oh, I'm risking $1 to make $10. You bet. Obviously, that's typically not a good bet, because they're basically saying you have a 10% chance of being right here. So what our goal is we try to find essentially opportunities to give us those same odds where it's like, yeah, you believe that this is going to go up, you betcha, where we can make substantial amounts of money, right, with limited downside risk. And so max you could lose on a $200 contract would be, again, $200. Well, guess what, guys? If you bought a $200 contract right here on NVIDIA, okay, I'm going to be very curious. And if you guys are curious to watch, right, load up on for those who are involved, watch the NVIDIA 175 calls. Okay, you can already see this is where they, got up to before market close. Again, imagine you bought at $1.99, and then when the stock market opens today, watch what the price of these 175 calls are, right? For those who know how to identify the price, they're going to be worth a lot. And so there are times where you will literally make thousands of percent on a play, where you could literally enter with $1 and you could make $100 on that $1 bet. And the max risk you had exposed was $1, right? Now that is obviously a rare scenario, but that's the possibility with options trading, right? There is limited downside risk, meaning you can only lose what you put in, and infinite upside potential. The last thing with this is, just because, we have that limited downside risk, we still never bet the entire amount that we're entering with. So if we enter with with $200 right here, we may only want to say, hey, if while we're watching the game, the live odds drop to where, hey, they're offering, saying, hey, your team's not doing too well. I know you bought calls. I know you wanted the Mammoth to win. Well, now they're losing. So now your $2 is actually only worth, you know, 180, or sorry, your $200 is now only worth $180. Well, we have at Uncommon rules where it's like, hey, if it drops more than this percent of our entry, we're going to get out because we don't want to sit around and wait and hope to see if it comes back. There comes a point where it's like, all right, the Mammoth are down 2 goals. It's probably time to cut our losses and wait for the next game, right? Wait for the next trade, wait for the next setup. And then it's the same with profit, right? Just because it's going up, we're up 50%. It's like, well, yeah, it could keep going up and we could make all of our money or we could make a lot more, but this could also happen where you could be up 50% on your trade and then it could start going against you. Now you just lost all the potential profit and now it's losing and we don't want that either. So that's what our strategies are is it's showing you roughly how much we want to risk on any given trade and roughly where we want to take profit on any given trade. Okay. So does that concept make sense? I feel like this is probably one of the best, easiest ways we have explained the stock market and stock options, if I'm being honest. It's just very logical based. I think it makes sense on how things move. And I think that it really illustrates what our goal is, right? Because I think when you think about day trading, you're thinking, oh, I got to figure out all this. It's like, no, no, no. We just care about what's happening in the immediate now, right? In the immediate now, short term, right? And hopefully it also makes sense of, oh, that's why option contracts move so much faster than if you own a share in a company. Or, oh, that's why I can make money when the company is losing value, right? So hopefully that all makes sense. So with all that being said, the trading kind of parameters, what we look for, we are always trading weekly expiration contracts, meaning they expire that week. When you start getting good at trading, you can start trading what's called same day expirations or next day expirations, meaning the contract expires that same day or next day. Because the closer the expiration date that you can see here, the faster the money's going to move, right? Because again, it's like, yeah, there's not much time. You're essentially betting on one game. You're betting on 2 games worth of time for this thing to do what it's going to do. Um, so what we're going to be doing moving forward, okay, what we're going to be doing moving forward is as we start continue to talk for the rest of this week, we are going to teach how to identify the prices of the contracts, right? When we're trying to buy and sell, what these strike prices mean, what the premiums mean, which is how, essentially the name of the contract and the price of the contract. And then we're actually going to dive into this week what we're looking at here, which is how do we read the price of the stock, right? Because watching a sports game, pretty easy. You can see when, you know, a team is winning or a team is losing. But it's not so easy to tell, right? With stocks, there's more factors, there's a few more things going in. But because there's a few more factors, a few more things going in, we can actually predict and accurately identify, hey, I know the Mammoth are up 2-0, but there's still a good chance that they're going to lose because of XYZ, right? And so that way we can kind of anticipate and play that. Or, hey, I know NVIDIA looks like it's going up right now, but because of XYZ, we actually believe that pretty soon price is going to start moving the other direction, right? And that's what it's all about, is identifying those things. So for the rest of this week, we're going to be learning the rest of the genetic makeup of these option contracts, and we're going to be learning about what we're seeing here on the screen. So is there any questions here for maybe a minute or two about stock options, what those are, how those work, and stock equity or shares, buying into a company and investing into a company long term? Any questions there? Luckily, the Mammoth have been doing a lot of winning. So if I was buying calls on the Mammoth as of late, we would be doing quite nice. Hopefully everyone is following along makes sense. And again, hopefully this has been the one of the clearest explanations of how it works, right? Yeah. And again, I think when you guys leave our sessions, I want you to be like, wow, that's incredibly simple. Like, wow, yeah, that makes total sense. Like, what's the big deal? Because that's not how most people view the stock market, right? We just explain an extremely complex system, financial sector, market, whatever. And I truly believe that we did it in a way that makes perfect sense. So tomorrow, we're going to pick right back up where we left off, and we're going to be going over it again, right? More involved with everything. Generally, when there's volatility the day before, can you expect it the following day? Surge, it just depends, right? Doesn't mean that it's going to have volatility today just because we have volatility tomorrow, right? In our Discord, you can see, check the options outlook. It will give you an idea of what we're looking at, okay? All right, guys. Well, we had a few Discord problems this morning, so I'm 5 minutes over our time limit today, but I appreciate you guys being here. Really, really fun. It's going to get more fun as we continue moving forward, identifying these things. Again, big takeaways from today. I want you to remember owning a stock or owning shares in a company, that's like an ownership in a sports team. Trading options is like betting on the individual game or on the series or on, the month of October, the results, or, betting on, their win record, whatever the case may be, right? And that's the biggest difference. And again, when you bet, you can make money betting against the team. You can make money betting for a team. No difference here with options contracts. So, with that being said, thanks for being here. Again, we're going to work on a few Discord things. A lot of exciting stuff coming up tomorrow. We're going to be going over some really, really awesome information, getting into the charts. When we get into the charts, guys, really we'll be starting tomorrow. Oh boy, that's where it's like bing, 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 bing. Light bulbs going off. You're going to start making sense of everything. It's going to be really, really cool. So, I appreciate you guys being here. Thank you so much. If you need anything else, let me know. And I will plan on talking to you guys tomorrow. So thanks a bunch, guys. Have a good rest of your day, and we will talk soon. Peace.